Okay, good afternoon, everybody. I'd like to call the Finance Committee meeting to order, please. And let's see, Doug, is there any public comments this morning?
No public speakers this morning.
No public speakers. Then the first order of business is the approval of our minutes of our February 27th meeting. Second, please. All in favor? Opposed? Minutes are so approved. Doug, you want to take us through the committee work plan, please?
Yeah, sir, there are no changes to the work plan.
Okay, and then would you like to go into Budget Watch right
Sure.
after that?
This month we'll be talking about preliminary results from February and March. And I'd like to report that results are very close to plan, slightly favorable, as favorable operating results, mostly from favorable passenger and toll revenues and some favorable expenses, were offset by lower subsidy receipts, and I'll get into the individual components of that now. Passenger revenues for the month were better than by budget by $5 million, or 1.3%, which increased the year-to-date favorable variance to $6.6 million, or 0.9%. Commuter railroad performance in particular was very strong in February, and it appears to have been benefited from both favorable weather and higher New York City employment. We got new projections from the Bureau of Labor Statistics that were favorable to those numbers we used when we did the budget. Long Island Railroad was 6.6% favorable for the month, and Metro North was 3.7% favorable. New York City Transit passenger revenue was on target for the month. Their numbers don't benefit as strongly as the commuters and B&T when it comes to the New York City labor numbers. Bridges and tunnels also benefited from the same factors. February toll revenue was better than budget by $5.5 million, or 5.2%. Year to date, that favorable variance is $7.2 million, or 3.3%. I'm going to move next to operating expenses, which were favorable to budget on both a monthly and year-to-date basis. That variance was primarily in non-payroll expenses. For the month of February, they were $32.3 million, or 4.4% favorable. Year-to-date, that's $43.2 million, or 2.9% favorable. It's early in the year, and those are the types of expenses that you typically would see timing variances in. On the other hand, agencies are in the process of developing some $40 million in reduction exercises that we had incorporated as a below-the-line adjustment in the February plan. So there's the likelihood that some of that favorable variance is going to be used for some of those expense reductions that we will see between now and ultimately the July financial plan. While expenses are favorable, overtime costs have in fact been unfavorable for the year. There were about $7 million unfavorable in January and another $2 million or so in February, and that's in spite of some favorable weather, so that's something we're looking at very closely. Some of that overtime variance was timing. Some of it was due to additional maintenance and some vacancy coverage. So again, that's an area that we have a little concern about, and we're going to be looking at that very closely. Moving to debt service, February costs were $12 million, or 6.6% favorable. Year to date, they're $12.7 million, or 3.5% favorable. Both instances, lower variable rates and timing appears to be playing a role there. So, like I said earlier, the passenger revenue and expense story is a good one. The subsidy story is not quite as good. It's not good. It's bad. March payroll mobility tax receipts of $104 million were $16 million, or 13% below forecast. Year to date, these receipts were below forecast by $34 million, or 7.3%. There was some timing. There was concern that, or the thought that some of that might have been timing, but it really looks like it's being driven primarily by lower bonuses on Wall Street and the financial services. It's been reported that those bonuses are between 14 and 24% lower than the same period last year. So it looks like those are probably real losses, but on the other hand, they are pretty much one shot because the bonus period is pretty much over. So now hopefully we go into a norm. We don't think so. We don't think so. But the way that we calendarize the PMT, because of bonuses, we are heavily weighted in the front part of the year. So it looks like most of the damage is done, but it probably appears to be a real hit. Sure.
Is PMT, how is it's on the payroll, it's on the number of employees?
It's
so
the number of, the employer pays it, but it's based on payroll.
so not the number of employees, it's
That's
how
right.
much you pay each employee.
That's correct.
That is the factor.
That's right.
0.34%, yeah.
Yeah.
So you could have, if you pay a one person $1 million or 1 million people $1, you pay the same tax.
That's correct, and that's why Wall Street bonuses
Okay.
have a significant
Thank you.
weighting when it comes to this. Yeah, you're welcome. Okay, MTA aid was below budget by $12 million or 16%. Those are the other new taxes that were part of the bailout, if you will. That appears to be pretty much timing related. We're going to get a $9 million payment in the next quarter, so that's something we're that concerned about. PBT receipts were unfavorable by $4.5 million, also timing. Total real estate taxes for March, real estate taxes were $7.4 million or 13.3% below the budget, and year-to-date those receipts are $10.8 million or 6.5% unfavorable. So they are running a little bit lower than what we had anticipated. One good news with regard to subsidies is we got an unexpected $10.7 million MMTOA payment from the state. They actually had additional receipts in their last fiscal year that they forwarded $11 million to us. So that offsets a little bit of the unfavorable subsidy numbers that I've been talking about. I know I've covered a lot of different numbers, some good, some bad. They actually do net out to a slight favorable for the period. So we're running just a little bit above budget, favorable for the first quarter.
But the important thing is, if we wouldn't have had the expense savings, the 40-some-odd million dollars, then we would have been in the hole. So
Yes.
I think what it tells us is that if you look at it, there is a trend that the subsidies are going to be lower. The real estate seems to be running lower, the payroll tax lower, and it's really important for us to double down on the expense savings and not sit back, because otherwise we can find ourselves, as time goes on, in a situation where we don't have the cash to pay the bills.
Yeah, that's the
The expense is very important. That's a big part of the
Yeah.
reason that we came out the way we did for the first 3 months.
Yeah, and between now and the July plan, we'll have some more information here. We'll look at how the expense trends are going, and we'll see what we need to do to come into line with a balanced plan for July.
Mr. Chairman, along those lines, and I think you alluded to it somewhat, there was supposed to be identified $40 million in savings within the fiscal year. Where are we at towards that effort? Because we're now a quarter into the fiscal year.
Okay, good. Yeah. Agencies were given, each agency was given a percentage pretty much based upon the size of that agency, of the reduction that they'll need in order to meet that target.
And when was that done?
Well, they're in the process of doing that. They were given the targets last month, I guess, and they're supposed to get back to us next month with their plans for achieving those targets.
And I would say it wasn't a surprise to them that they were given targets, because the target percentages are pretty much what they've been, and everyone knew.
Bob, you turned your thing off. Okay.
Okay. And everyone knew that we had this $40 million cut. So I think people have been anticipating that it was coming, and now we'll agree with them on what the cuts will be.
Okay, and you did not say that you were looking to offset that by any of this revenue that we may be upticking. We're still going to do those $40 million in
Yes.
cuts.
Well, keep in mind, like I said, that some of the expense reductions that we've seen, there's the likelihood of a timing element to that. So you see that as Chairman Saul said, there are real reductions in the subsidy side So we're not really sure exactly if the expense sides are real or timing. We definitely need those cuts unless there's some dramatic change in our environment that I don't know about.
Except when you take cuts, you're taking cuts against budget, right?
Yes.
So if you're down against budget,
Yes, that's correct.
that's a step toward the cut as
So
a
that's
practical matter.
If in fact these are real, they could in fact be used by the agency, but the agency also knows that the cuts that they identify need to be recurring. The assumption is that any cuts they take are recurring in future years as well.
Okay, Doug. Thank you, Doug.
You're
Next thing, Pat, you're up, Finance Watch.
Thank you. Finance Watch begins on page 4-1 of your committee book today. Before I get into that, I would like to begin with a quick update on our request for a waiver of the state bond issuance charge. I know that's been a topic that we've discussed. We did submit a request to the state budget director, and we'll report back when we get a response on that. So the request is in with respect to all refundings that we will be doing or anticipate doing this year and next. And again, we hope to hear back very soon from the budget director on that. So, moving on to the report, we have a few transactions to report. We issued $400 million of transportation revenue bonds on March 7th through a competitive method of sale into a very favorable market. The transaction was broken into two components designated as 2012A and 2012B. And this was part of the January authorization that the board approved of $1 billion of transportation revenue bonds. The 2012A bonds were structured as floating rate notes in three subseries of $50 million each. Each subseries has a soft put date, and that essentially means that the investor holds the bond for either 1 year, 2 years, or 3 years, and then they put the bonds back, and we would at that time remarket the bonds to some other period, whether it's 1, 2, 3 years or longer, depending on how the market is at that time. The bonds reset weekly based on SIFMA plus a spread, and that's what we asked from our bidders. The A1 bonds will reset at SIFMA plus 14 basis points, and SIFMA is the Securities and Industry Financial Markets Association municipal swap rate. Today that rate is 14 basis points. So those bonds will trade at about 28 basis points for this weekly period and so forth. The A2 bonds will reset at SIFMA plus 19 basis points and have a soft put in 2 years. And the A3 bonds will reset at SIFMA plus 39 basis points with a soft put in 3 years. All three bonds would adjust to a penalty rate of 11% in the event of an unsuccessful remarketing. And so to mitigate that risk, we structured the bonds with a long 6-month call provision that would enable us to weather any sort of market turbulence that could hit us. And as you can see from the tables at the bottom of the page, the all-in TIC on the floating rate notes is 4.10%. And I just want to note that that's an assumed rate because we budget. It's a variable rate product. We budget all of our variable rate bonds at an assumed rate of 4%. So, as we have experience with the bonds, that will get reflected in the monthly finance watch. So, beginning next month, you'll start to see how those bonds have actually reset, and then our all outstanding report that's always included in Finance Watch. Actually, when it shows the all-in true interest cost, this is Roman numeral 4-10. That's to date, and so you'll see how those over time how those bonds reset. Sure.
Penalty provision again.
So an investor that buys for example, the A1 bonds, it's a 50 million tranche of bonds, holds those bonds for 1 year. They have a maturity of November 15th, 2013. If we get to November 15th, 2013, and we've failed to remarket those bonds and provide proceeds to pay off that investor, then the investor continues to hold the security, and they kick to an 11% rate. That's a penalty rate. So does that answer your question?
Well, I guess the follow-on question would be, what, that seems, well, we should always have market access.
Correct. It's presumptive on market access, and again, as I said,
what benefit do we gain price-wise to assume that risk?
Sure. Well, obviously, it's the rate, and for that bond, for example, as I said, it's SIFMA plus 14 basis points. So in the current market, we're paying 0.28% on that bond.
And Jim, remember, there's no letter of credit or standby purchase agreement behind these, which is the kind of traditional structure. So that's the benefit we get, and they just want to make sure we have a strong incentive to remarket it, and the 11% clearly is a strong incentive.
What would the price or the rate have been if we'd chosen an alternate variable rate structure?
Well, that's the interesting thing. I mean, what we've found by reaching out to the bank, to banks that would participate in providing either standbys or letters of credit, and in this case, we would need a letter of credit. There just wasn't the appetite on the part of the banks to come in on the transactions. We know that based on our schedule, we're going to need approximately $600 million in variable rate capacity later in the year. So that very precious bank capacity that is there, we're going to reserve that to use later in the year on some transactions that we're going to need where we've got swaps in place that we need to have variable rate bonds attached to. So this, in terms of comparing this to a letter of credit, I think it
not necessarily even a letter of credit.
Well, you asked if we compare this to an alternative variable rate product. Really, the only variable rate product that we can compare it to is either a daily or a weekly variable rate demand bond that resets periodically. Again, with the support of a bank that would stand in there to take the bonds in the event that an investor wanted to put them back.
I don't mean to interrogate you here, but
that's all right.
If we alternate structures, I would say could even be a short maturity, a 2-year maturity, 3-year, whatever. But it's just
sure. And
the idea is that this starts to smell like these auction reset bonds that we were talking about that we're just getting out of now. And I mean, it's a different deal, but I don't like it.
But just maybe what you should be comparing them to is what it would cost you to finance this amount of money fixed rate to maturity right now.
Sure. Okay. And in fact, that's the next part of my discussion, because on the same day we priced $250 million of fixed rate bonds, and as you can see here, that all-in TIC was 3.85%.
And so the other thing to keep in mind is that if on the conventional variable rate where you have bank credit support behind it, generally the term of the bank credit support is not as long as the maturity of the debt being supported. And when you read the fine print on what happens if you go beyond the initial contract term of the bank support, you tend to have a penalty interest rate that you're paying to the bank, which may or may not be comparable to this amount of money, but it is
comparable.
Yeah.
Right.
This is not a major source of financing here. It's a piece of the total thing.
So just a couple other things to point out. When we issue these bonds, we issued them with our multimodal document provisions that provide for us a lot of flexibility in how we remarket at the time we need to. Again, with that 6-month call, we can stay in the existing what we call term mode and go out for, say, another year in this same type of structure. If there's a lack of market for that bond at that time, we can fix out. We can, if bank support comes back into the market, we can bring a bank in and issue them as weekly or daily VRDBs. So we do have that flexibility. We could even go into a commercial paper mode. So there's certainly a lot of flexibility in the underlying documents, and that long call provision we feel is more than adequate to achieve the remarketing we need to do.
I'm not going to beat it to death, but I guess we've been through enough turbulence over the last several years to know that there are a lot of things that are out there that nobody ever contemplated, and you wake up one morning and you're face to face with it, and I guess that's my only concern.
Okay. Go ahead and we'll.
Okay. So the bidding was there was actually strong bidding on all three tranches of the notes. 13 bids on the A1, 12 bids on the A2, and 11 bids on the A3. The A1 bonds the bidding was won by Bank of America Merrill Lynch. The A2s and the A3s were won by J.P. Morgan Chase Bank. That same day, again, as I noted, we priced $250 million of fixed-rate bonds, again, through a competitive method of sale. We had 8 bids, and the all-in TIC, the low TIC bid was submitted by Bank of America Merrill Lynch. Any more questions on the notes part? Okay. So we want to talk about the competitive method of sale here on the B bonds. Pricing resulted, again, as I noted, all in TIC of 3.77%. This compares quite favorably to the overall TIC on the entire portfolio of TRB debt of 4.81%. So obviously a good result for the MTA and reflects favorable market conditions. We spent some time analyzing the results here to 2 other most recent fixed-rate transactions, and the most recent one being the $500 million 2011 D bonds that we priced in late November 2011. That was senior managed by Ramirez together with Loop Capital Markets, both of 2 MBE managers. We also compared this to the March to the 2011 A bonds sold in July 2011. And we zeroed in on that transaction because it was priced by Bank of America Merrill Lynch, the firm that won the bid this time around. We had obviously very strong market conditions now, and I would note that the competitive deal we priced here that was roughly half the size of the 2 negotiated transactions. As for retail pricing spreads on the November 2011 negotiated bond sale, again, that was the Ramirez deal, we're very close to the tight spreads achieved on this competitive deal and lower. And when I say spread, I'm talking about basis point spread of the bonds against the municipal market data benchmark, the AAA benchmark. And so we always look at that as to how the bonds are accepted in the market. I'd say we attribute the success of the new pricing strategy that we treat retail and institutional investors in a more equitable manner and putting both classes of investors in competition to produce the most aggressive pricing on the bonds is a reason why the competitive deal that we did now compares very favorably to that negotiated transaction last November. Based on the analysis of spreads to MMD to these 2 negotiated sales, as well as the March competitive sale, we concluded that while certain parts of the yield curve for the competitive transaction seemed to be better than the 2 negotiated sales, other parts, particularly the long part, where it really matters the most because that's where the bulk of the debt is going, spreads were wider than on the competitive deal than on those 2 negotiated deals. So overall, we believe we've achieved good pricing on our negotiated deals in comparison to this. Okay. Sure. Okay. On page 4-2, just a brief summary of our fuel hedging program. We executed a 12 million ultra-low sulfur diesel fuel hedge on March 1st. And again, they were competitively bid with our 3 approved counterparties, and Deutsche Bank was the winning bid. We locked in a price of $3.21 a gallon. So the details are there. Moving on, dedicated tax fund bonds, Series 2002-B2 and 2002-B3. This is the remaining restructuring of the transaction, the 2002-B deal that has the bank support from Dexia Bank. And as we've talked about in prior meetings, Dexia Bank is not trading well in the market. They're exiting the business, and quite frankly, those bonds are costing us a great deal more than our other variable rate bonds supported by banks with better ratings. Yeah.
Just a quick question. How long is that fuel hedge good for?
That's an 18-month.
18 months.
Yeah. So I would just point out on this restructuring of the DTF 2002B, we've had one CUSIP, one bond out there supported by that bank. Because market conditions are very different now than they were when we put that deal together in 2002. We're now down to 9. We're up to 9 CUSIPs. So we've broken the transaction into multiple pieces. $277.85 million of bonds completes the first part of this. The 2002Bs were priced on March 20th. We're keeping the existing amortization schedule of the bonds. We're not changing that in any way. And principal scheduled for repayment 2014 through 2022. We worked with Morgan Stanley, who's the existing remarketing agent on the 2002B bonds, to do this. And so we priced $116 million of fixed-rate bonds, and then we priced $161 million of floating-rate notes. This is a little bit different floating-rate note than the one I talked about earlier. This floating-rate note has what we would call a hard maturity. There's no remarketing necessary. And so there's no penalty rate. The bond matures, we pay the principal, and that's it. And that works out well with this deal because of the way the amortization works. Again, we're not altering the amortization. So we did 4 sub-series of those notes, and they're described here, the B3As and so forth. And those amounts are, again, the existing amortization. The way the pricing works on those is that spreads were 75 basis points, 90, 95, and 1. And the structure was laid out such that the bonds mature in years 2017, 18, 19, and 20. So,
Pat, a question, not to appear stupid. What does CUSIPs stand for?
Oh, I'm sorry. A CUSIP is like think of it as a serial number that's a unique identifier for a particular bond.
For the Committee on Uniform Security Investment Procedures or something like that.
Jim, I think, Jim, what this transaction right here represents is a place where we are looking at various ways of hitting the shorter-term market. So you see that there's floating rate notes with an index. You see some fixed rate notes that have incredibly low rates. And then you have a letter of credit backed or a standby purchase agreement backed variable rate. So we are trying to take advantage of all those different market opportunities that you said, and we do view that a fixed rate note on the short end of the yield curve is just as attractive sometimes as floating rate debt.
So the remaining part of this restructuring it involves $150 million of weekly VRDBs backed by State Street Bank, and this was the result of a solicitation that we put out, and the bank came in. That OS is on the table. It was also emailed to you. And that so that all the components of this restructuring will close this week on Wednesday. Good. Thanks. So.
One other thing. The fuel hedge was going to put us, by my calculation anyway, about $816,000 in the hole versus budget. Just wondered if we can, as we put these hedges on, if we could sort of do a cumulative calculation of where those hedges are putting us relative to budget. I mean, $816,000 is not going to break the bank, but it'll build.
Yeah, it's good year-to-date, too. If you remember the first hedge that we put on, which was the bigger hedge, about $50 million, I think we put that on at a $2.89 or a $2.90 cents a gallon. And again, what we're trying to do is we're really trying to maintain budget certainty. And so by going out 18 months on each of these and doing them roughly once a month, we are building in knowledge of what our future prices will be. So we will keep you posted. But again, we're doing this really for budget certainty, and sometimes we're well below budget as we were on that first hedge. Other times we're above budget, but that's because the market conditions have moved. So
I'm in favor of it, and I understand that certainty is really worth something. It's just, and you're going to do better or worse, depending.
I would just note, though, for the amount that we've hedged, our weighted average cost is $2.99 a gallon, and that's spot on with the budget for this year. So. Right. So the last thing is to report on our upcoming transaction. This is the Transportation Revenue Bonds 2012C. That's $600 million. That's the remaining part of the January board authorization of $1 billion. So I talked about the first $400 million. We've executed that. The remaining $600 million is going to be issued as fixed-rate bonds through a negotiated sale. Wells Fargo is a rotating senior manager. They're up. M.R. Beal is going to be special co-senior. We're pricing April 17th and 18th and closing on April 26th. Okay.
Do you have a tri-bro that you need approval for?
That's coming up in the.
You want to do it now, Mark?
Yeah,
Sure.
now we're coming up to MTA headquarters and all agency items. And there's,
Andy?
two action items, the first of which is the approval of
Andy?
MTA.
May I
general
ask
revenue
one question?
bonds. Oh,
To what extent have you made provision for minority entities to be part of the underwriting effort?
Sure. The underwriting group that was approved by the board in December of 2010 includes two WMBE managers as part of our group of 10 seniors, so that 20% of our group of 10, and our co-manager group of 16 managers, actually now 15 due to a consolidation, includes 4 firms that are WMBE managers. So, and what we're doing, as I noted here, M.R. Beal, one of our WMBE co-managers, is being elevated to the role of special co-senior in this transaction, and we do that in most of our transactions by elevating one of the co-managers up, in addition to the fact that 2 of the senior managers are WMBE managers.
Would you at some point send me the list of those that you have put in?
Certainly.
Thank you.
okay.
Why don't you MTA bond?
Okay, so before the committee is a staff summary on Roman numeral 5-1. It comes together with a supplemental resolution. This is to authorize the issuance of TBTA General Revenue Bonds, Series 2012A, in the amount of $250 million.
Motion, please. Second, please. All in favor? Opposed? So moved.
Question?
Thank you.
Okay, guys, we good?
What is the aggregate amount of bond approval we've given to date for calendar year 2012?
With this Triborough deal, $1.250 billion.
And how much have we gone to market with thus far of that $1 billion?
$400 million.
$400 million, okay. Because I'm just concerned, when we're seeking the budget director's waiver, we're going to be looking for retroactive application of the fees that they're charging us for these things?
No, the request is with respect to refunding transactions only. We expect to continue to pay the BIC on new money transactions such as this.
Why aren't we requesting it for new money?
New money issues for all issuers throughout the state have been included in the budget, in the state budget, and they weren't prepared to reduce the size of the state budget by the amount of new issuance. It's been the refundings. And my conversations with Bob Megna, as well as others on his staff, I pretty much feel very comfortable and very confident. They really want to do it on a bond, on a refunding by refunding basis. But I know, given the bills that were printed last night, they're not assuming it in the budget, so I feel very comfortable we will be getting, each time we do a refunding, not the application of fees.
Okay, and I understand their budget problems. I just think as a matter of public policy, that the point being that we're essentially a public agency operating for the benefit of the City of New York and the State of New York, who would not be charged to do these transactions on new monies, that we should be pushing this issue continuously, even if we are not successful in the short run. In the long term, that we should not be paying tax on money that they're forcing us to borrow in the first place.
Where the governor appoints majority members.
Right. This is it's not just the MTA, it's all state authorities, the dormitory authority and others as well. We'll work on that as make it a legislative agenda item for the MTA.
Thank you.
Okay.
Next.
Doug?
One more action item, the staff.
Thank you very much for that.
Yeah.
Mr. Schwartz.
There's a staff summary to authorize the filing with the State of New York, the annual MTA All-Agency Procurement Report for the period January 1, 2011 through December 31, 2011, as required under Section 2879 of the State Public Authorities Law. What used to be a big fat buck, I believe now you've been given a CD, and we need a motion on that.
Okay, a motion, please. Second, please. All in favor? Any opposed? So moved.
The next is report and information items. We have the MTA Prompt Payment Annual Report for 2011, and this report reviews MTA wide success in meeting mandated prompt payment deadlines, including the interest penalties incurred as a result of late payment. In 2011, the MTA paid a total of $31,000 in interest charges on total invoice value of $8.6 billion. Just for your information. Okay.
Comments?
Comments or questions?
Just an information item. We don't need a vote.
Right.
Okay.
Next on the agenda are headquarter procurements.
Before we do that, Joe, do you want to jump in now for a second?
Yeah, I'd like to give an update on the activities up in Albany this weekend and the budget that will be put forward. I'm happy to report, as was in one of the newspapers this morning, and I actually talked to the press about this earlier today, there is agreement in Albany in increasing first off, on our capital program. Our capital program is going to be accepted as we proposed it back in November and then updated again in December. The state has put forward the $770 million of direct funding. Obviously, in that plan, we're still looking for the opportunity of being able to get the $2.2 billion RIF loan from the Department of Transportation. Our debt cap was lifted, as we requested, to $7 billion. And overall, the most important thing is that the strong commitment that was shown towards mass transit by reflecting in our capital program. As you know, it was put forward by the governor in his plan in January and agreed to by the Assembly. The Senate was not there. We spent the last probably, week negotiating with the Senate. Really came to fore on Friday, Saturday, and Sunday morning. And I'm happy to report that they're moving forward with that, and the vote will be on Wednesday. As I understand it, the actual legislation was laid on their desk this morning, so it's in the aging process. And I also wanted to report on the information that I had that I'd received from Bob Megna, verbally from him on the bond issuance fees, so, of which I feel really comfortable. So our capital program moves forward. Now on to the good work of continuing to implement and work on those projects. And as I've told the staff this morning, it's not too soon to start thinking about the next 5-year capital program. Okay, that's it.
Terrific. Okay, Doug, procurements.
Yeah, next on the agenda are headquarter procurements, but we have Diana Beecher and Cliff Shockley to talk about a few unique procurements here that we thought would be interesting for the committee to hear about.
Before you go, I just like to say that this is something that we started, Cliff, about a year and a half ago, 2 years ago, with a demonstration from Mount Sinai Medical Center here, which had done a lot of e-commerce and is now currently doing about 50% of their procurements on the web and saving a tremendous amount of money. And when you get this report and you see what's happening here, you're not only going to see the huge amount of savings on these e-commerce procurements, but how we are now ramping up to go forward so that this e-commerce becomes a bigger part of our procurements. This is really big bucks here, really major money, and it's under the control of the business center. Diana is the manager, the head of the business center, and Cliff is our procurement person in the business center, and they have told me that this is going to be a major focus going forward. So I think this is very exciting. It has the possibilities of huge savings for the MTA. I mean, really big money, and I'd like them to tell you a little bit about what's happening, and I hope you're as excited about it as I am after you see what they're doing here.
Cliff is going to take you through just a couple of examples of the successful e-procurement that we've had so far. We are learning how to do it, and we are ramping up, and we have a schedule going forward through the summer to do more and more of what you're going to hear about. But we're getting fantastically good price improvements for the procurements that we're doing this way. And in addition, we're spending a significantly smaller number of labor hours of our own time to get to these prices. If in the past we had been able to even approach the pricing levels that we are enjoying with these e-procurements, it would have taken months and months of activity by our personnel negotiating with vendors. Because we're doing it electronically online in this e-marketplace, we do not have to spend the manpower ourselves to do this work. Cliff?
Good morning. As Andrew said, this board charged us about 8 months ago or so.
Talk a little louder, maybe.
I'm sorry. Can you hear me better?
Bring it closer to you.
Okay. As Andrew said, this board charged us about 8 months or so ago, starting a pilot program for e-procurement. Under that pilot, our first procurement was office supplies. We saved, with that experience, about $4 million. That was highly successful. I was a little surprised to us as well, because we had gotten savings from that program before, but not under e-procurement. So the number was quite big. I think it was 17% was what we actually saved in terms of doing that procurement. Quite recently, or in your books today, there are two procurements. One is the custodial, and the other is PCs. I want to point out the PC procurement in particular. We have in the past written state contracts for PCs. And on the average, we would get that same pricing, or we may get another 2 or 3% off of that. In this case, because we did an all-agency procurement under the electronic version, we reached, I think, 51 to 52% savings, better than the state contracts. That is phenomenal. That surprised us, to be honest with you. I just simply did not expect that. Also, with the custodial contract, as you know, most of you realize, the pricing on some of those contracts are controlled by prevailing wages. I did not expect a great return with that contract, but in fact, there again, we saved a tremendous amount of money. I think it was $771,000. In total, with all three of those contracts, we will not have to write a check about $8.5 million had we not done this process. So we're very excited about the process. As I said to Andrew this morning, in terms of the BSC, our goal is to become a e-procurement shop. That is to say that all the contracts that are coming across my desk, first I look to see if those contracts can fit under the e-procurement process. And so, we're very excited about it. I hope you guys are. And we expect to come to this board with a few more procurements of this nature.
Diana, maybe you could just tell us a little bit about what your plans are and how you're going to ramp this thing up.
After we had the first success with the office supplies, we challenged all the agencies to propose one e-procurement a month. And it has taken us the first 3 months of this year to get that kind of run rate going. It's easy for us to deal with headquarters procurements that are, come across our desks and are totally under our control. And as Cliff said, we have started to ask the question, why not, to each of those. But the really important way for us to save a lot of money for the MTA and to impact the overall operation is to have agency participation. We've now arrived at a place where we do have from each agency a couple of procurements scheduled within the next few months. And I believe very strongly, as Cliff said, that as soon as the agencies enjoy the success and they see what can happen by doing procurements this way, we're going to have more and more demand for it.
I would like to point out, particularly on the laptop purchases, they were standard laptops. We had one laptop, and that's been something that the IT group has been doing. That's something that within agencies we've been trying to get the presidents to work together and with the procurement people to work together to standardize as many things as we can across the MTA family. Because it's when we have large purchases offered of standardized products we can see these kind of savings. So again, the e-procurement is wonderful, but it's got to be done together with trying to minimize, all agencies working together and identifying where we can standardize our products. So
we have that proven and running in the technology arena, and we just have to spread the word and get it into some more areas.
Do you solicit the vendors, or do you just post it on the web, or what?
The way the process works is that we post on the web our general requirements. We describe what it is that we want to buy, and we encourage vendors to respond to that so that we can vet them ahead of time, so that we can live within the rules of procurement that we have to abide by. So there's a pre-qualification, and part of the pre-qualification is also to train the vendors in using the electronic market so that they don't make a mistake or that they don't get unfair treatment by not knowing how to do it. So that whole process happens, and then when we actually do the auction, it is open to all those who have pre-qualified.
My question really is there a point in time at which you will be able to solicit or notify vendors beyond just your website, people who are not trained to look at your website?
Well, part of that original process is that we do reach out proactively and encourage people to come and learn how to use the website. On the day of the auction, they have to know how to use it. Part of the auction activity is that vendors can see what pricing other vendors are offering to some extent. They can tell where they stand in the pack, whether they are the lowest, how much more aggressive they have to be to win. And it's really important for them to know what they're doing at that point in time. You can't be a stranger.
At some point, we ought to expand the pool of those that will know that they can use this process.
Each time that we go out, we encourage as widely as possible for everybody to come in and participate.
And Chuck, nothing's changed in terms of advertising. We still do the same process in terms of advertising these procurements through general publications. We still obviously we have a civil rights involvement in terms of the minority community. So those things are still intact.
Jonathan?
So this, I'm just trying to follow. So this is not a bid process, but it's an RFP process. It's kind of like a hybrid. Why wasn't this just, if it was a commodity type item, why wasn't this just bid through a closed, sealed bid?
The reason for that is, and legal can probably be a little bit more articulate than I can, but still our statute does not allow us to conduct an e-procurement with a straight bid. And so one of the more creative ways to enjoy this kind of process is to do it under the auspices as what's in front of you. And by the way, just coincidentally, I'm glad it happened that way because it works that much better for us. Because now I'm able to not just accept a number. I'm able to sit there with a contractor and negotiate that number. Why, how, etc.
But
So
you're
we are
negotiating
fine.
the type of product or the price?
No, you're negotiating. I'm sorry.
No, John, the world of e-procurement is really almost what you and I used to call a reverse auction. We want to go out and we want to buy the following 1,000 widgets. These are the specifications, and we put the rest of the world into competition, and we see where it is, and then they keep bidding down and bidding down and bidding down. This market has become so active with the use of the internet and e-procurement. There are companies, auction houses that have been built to be able to focus just on this area. So what you really need to do, once we know what the product is and the specifications.
Right, you need to know that, otherwise
Absolutely,
you can't
but a widget's a widget. And
yeah, it works for widgets.
it
but
doesn't
that's what I
work
was
for
trying-
rail cars.
But
It doesn't work for rail cars.
But it does work for things that are more complicated than widgets. It's maybe not rail cars, but not only widgets. So
Okay,
services,
all right.
for example, okay, which you can't buy with it. The custodial service,
Right.
which is in the book.
You actually wound up getting a new contract and saving $775,000 on this one contract, on this reverse auction. We would have given out, we were actually paying $775,000 less for the same services we paid for the last 3 years.
Okay, no, the results
This is one little
so-
contract. Are you kidding me? This is huge. We're just first getting it. That's my point. We are just first starting this. Truthfully, when I brought Mount Sinai in here, I saw what the hospital was doing on this thing, and it was unbelievable. They saved $50 million last year on purchases on this thing. We brought them in. They did a test here with Charlie Monheim, I guess a year and a half ago, right, Cliff? And we've been slow getting this thing going because we had also state statutes and stuff that we had to deal with. There were certain legal ramifications to comply with the state authority law. Anyhow, we're now at the point where you see how this thing is working, and the more that we can get done. Diana has a list there that she showed me, which she didn't show you here. For April, we have a whole bunch of them scheduled in all different areas that are going to be going up on the thing. And it's just first starting now. It's a major thing. Well, look, we're working on it.
So the 5 respondents had a little mini competition going on, that they could observe each other's responses. So they all broke through the barrier, and these guys just came way through.
Yes, each vendor, you don't know what the lowest price is. The only thing that you know is that you're not the lowest at that point. So we send out an email saying we have a new leader. Of course, and what that does, that makes you say, I don't want to lose this. And of course, then the bids start to flow in. Very interestingly, again, this is my third one. It's funny. It sort of it's slow at first. It's sort of because everybody's trying to figure out their positions. And the last, let's say, 15, 20 minutes, it gets crazy. Okay.
I should certainly know the answer to this. Are we exempt from city and state sales tax as an agency? Yes.
Yes.
And then when you're looking at these things, do you look at where the service provider is?
Is in terms of what city or state?
Yes.
No.
You don't?
No.
Well, I mean, it's something that we're obviously very concerned about in manufacturing of subway cars. And, I mean, if you're talking, if you're buying reams of paper, it probably doesn't make a whole lot of difference. If you're talking about a service provider with a significant labor component, it might be something that you would actually want to be awake to.
Right. And you stand correct, Mark. Each procurement stands on its own merit. So I think you're right. When we start to get into those kinds of things, obviously we have to pay attention to those kinds of factors. So you're right about that. And again, the system is flexible enough that it absolutely allows you to do that.
Andrew, I share your enthusiasm for this effort and urge them to expand and expand. I am a little bit concerned, though, at the opening comments about reaching out to the various procurement operations and asking them for ideas to participate. It is my hope that we're moving away from having lots of procurement operations on an agency-by-agency basis, except for those things that may be unique to that particular agency, like subway cars or buses or for that particular type of business, and that we are doing all of our procuring centrally for laptops, paper, things of that nature, so that we're not replicating unnecessary functions throughout the empire, so to speak. So, Robert, I would ask that we be looking at that as part of our effort to downsize the operations so that we're spending our dollars.
One of the things, and Jim and I actually, years ago, we started this thing. We feel that, and I'm speaking for Jim now too, that procurement, if you want to jump in, procurement was one of the biggest places where we could save money by uniforming the purchases, centralizing it, and obviously doing purchasing like the computers across the whole area of business that we serve. And that is something that the business center is working on. You're going to be hearing, I believe, Joe is going to be talking about this in the future. We are going to be centralizing more of this. And hopefully part of the centralization will be around the e-procurement. So this is going to happen, and we're going to do more and more purchases for the whole MTA family on this thing with uniform specifications. The answer is yes, 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 and it's going to be one of the big thrusts for the business center going forward.
Thank you.
Jim, you want to add to that?
Yeah, in addition to that, I think the thing that we've learned over the last, I guess, 5 to 7 years is that if we don't have the agency heads behind our project, it's hard to pull it together. So we've made them part of the program so that they're starting to buy into this general practice that we're looking at, and it's beginning to work. I can tell you 7 years ago, we didn't think it could work because we didn't have much, many of the agency presidents that said, oh yeah, go ahead. But now they are. Now they see, they're becoming part of it, they get some input in it so that they're not as far, they're not far away from the process, which what they were concerned about.
Okay. Mark, I'm sorry.
I hope that as we try to centralize procurement, we try to maintain an ability to have the provider of the good or service actually deliver to the agency or the location in the agency where that is required, because I mean there's a potential here to ourselves and be in the procurement and delivery and warehousing business, which you may find eats your savings and is not particularly efficient.
We did it with the Staples contract, Cliff, remember?
That Staples is good for that.
That was a perfect example of what Mark's
Yeah,
talking about.
yeah.
Is that working out well for you?
It's working out very well. Okay.
I think it's a concept that we need. I mean, I think Staples has, I know with the city, Staples has an excellent reputation on that score, but I think it's a topic that we need to remain very sensitive to overall.
Okay. Doug, would you take us through the procurements
sure.
now so we can formalize this, please?
So there are 6 competitive procurements for headquarters for a grand total of $24,194,000.
Motion, please, and a second, please. All in favor? Any opposed? So moved, Doug. Go ahead.
Sure.
Just keep rolling.
There are no items for Metro North or Long Island Railroad. Next on the agenda, we have MTA bus operations. We have 1 non-competitive procurement for NYCT and 1 competitive procurement for MTA bus for a grand total of $28,043,692.
Motion. Second, please. All in favor? Any opposed? So moved, Doug.
Next, there are no items for bridges and tunnels. Next on the agenda, we have one joint competitive procurement for New York City Transit with Bridges and Tunnel for a grand total of $979,974.
Motion, please.
Yeah,
Second,
I got it,
please.
yeah.
All in favor? Any opposed? So moved.
We also have a walk-in competitive procurement for New York City Transit for $599.5 million to purchase 300 new B Division subway cars and related non-car items such as spare parts, special tools, diagnostic equipment, technical documentation, and training. I believe everyone received a copy of that on the desk.
Okay, there's a motion. Second, please. Before we vote, I just want to say that in this procurement, Bob and the team from Transit and Tom have done a great job on the spare parts procurement. I know Chuck Murtha talked about this early on, whereby we're going to have, what is it, 20-year commitment, or as long as the life.
Yes.
Bob, why don't you just mention this a second, because I think it's really something so important for us. This life.
There are a few new innovations in this contract. One of them is what you just mentioned, that the proposers were asked to, and they both agreed to be available to supply spare parts for the next 20 years, or to be responsible for supplying the spare parts so that we don't have a problem. Another innovation was, there's been a lot of concern on the board, and on our part as well, of course, about the cost of sole source parts. Certain parts are original equipment manufactured, and we often have to, not often, but we do have to buy sole source parts because they improve the reliability of vehicles. What we got here from both proposers and from the winning proposer, Bombardier, was a commitment to demonstrate, when it's time for us to buy those parts, to demonstrate the actual cost to them of acquiring the parts, an auditable cost. In other words, we'll be entitled to audit what they say the cost is, and then they've capped their profit on that cost to 8%. So that's one way, that an innovative way for us to control the cost of OEM parts.
Really, a compliment. Huge, sure. It's a huge thing.
I think it's great. My only question would be, since the average life of a subway car is 40 years, what happens after the 20? Then you're liable for the cost of the parts?
Well, we're always liable for the cost of the parts. What we've gotten is a commitment to have those parts, to have the manufacturer stand behind the availability. I mean, obviously, we have cars now that are 40 years old.
Sure.
And we still are able to acquire parts, sometimes in the marketplace and sometimes through the original supplier. Yes, we did.
The other thing we wanted to talk about is this product cost down.
Yeah, you got it. You said Bob, is there anything else you wanted to say on that, or
No.
the contract? So, a motion, please. Second, please. All in favor? Opposed? So moved.
There are no FIMTech items. I think we'll turn the meeting over to Jeff in the real estate portion.
Thanks, Doug.
Jeff, go ahead for the real estate.
Thank you, Andrew. I'll be brief. We have 3 action items this month. The first is become a kind of annual rite of spring. It's required by the Public Authorities Law, and it's approval of our all-agency real property disposition guidelines and all-agency personal property disposition guidelines. We've labored over these in the past to try to make them work better and to comply with the new requirements of the Public Authorities Law, but this year, with only very small technical amendments, we're asking you to approve them in their previous form. The second is simply some technical adjustments to easements in favor of the Village of Larchmont that you approved in January. And the third is to do with coffee truck licenses on Long Island. In January, we brought you 4 proposed licenses, and we have another 7 this month. I will say that there's been some disappointment on the part of some incumbents who have not been able to retain their licenses despite having, we didn't do e-commerce, but we had multiple rounds of bidding, and in some instances the incumbent has been displaced. But I will tell you that the increase in the fees from these concessions is 5-fold. Which I think, if anything, is evidence that it's taken us too long to, honestly, to put these back out.
Unless there are questions, I'll just ask for approval of those items.
Motion, please. Second, please. All in favor? Any opposed? Jeff, so moved.
Thank you.
Do you want to say anything, comment quickly on the long-term plan here, or?
Well, I think I gave a report as recently as last month, Andrew. So it's been a long meeting. Unless you want me to comment on a specific element, I think I won't. We have a few pieces of the plan that are coming together nicely, and I think in the next month or two we'll have some more developments to report on.
I think that's
Okay.
sufficient. All right. Okay, so.